Okay, let's unpack this. Welcome to the Deep Dive, where we take your source material and turn it into knowledge you can actually use. Today, we're diving deep into the 2024 annual report for Khong Guan Limited.
That's right. And this isn't just, some dry financial document. It's really a window into how a company navigated a pretty challenging year. The report covers their financial year that ended July 31st, 2024. So it details their performance, the hurdles they faced, what they're looking at for the future, and importantly, how they run things at the top of their corporate governance.
Yeah, and our mission here is to go through this detailed report together. We want to pull out the absolute must-knows, maybe some surprising facts, and basically give you that shortcut to being genuinely well-informed about Khong Guan Limited's past year and, well, what it might mean going forward. Think of it like getting the key insights without having to read all, 100-plus pages yourself. Ready?
Absolutely. Let's start with the core numbers, the performance for FY 2024. The report shows a dip in the group's top-line turnover.
Right off the bat, yeah. Turnover was down 2%, coming in at $70.159 million. Now, a 2% drop, it might not sound huge on its own.
It might not, but when you look at why it happened, it tells you a lot about the market they're operating in. The report attributes this decline mainly to weakened demand and pretty intense price competition.
Okay.
This impact was felt particularly hard in Malaysia, which is a significant market for them, hit their wheat flour and starch businesses especially.
So it wasn't just a slow year. It was a year where they really had to fight harder for every sale, often at lower prices, it sounds like. And digging into their subsidiaries, we see slightly different pictures, right? Tongguan Food Products, TGF.
Yeah.
They actually saw modest revenue growth.
Yeah, 1% to over $41 million. They managed increased sales across most products, which, sounds positive. But buried in the details, the report notes that this gain was partially offset by the depreciation of the Malaysian ringgit against the Singapore dollar. So this tells you that even when your sales volume improves, currency fluctuations can really eat into that reported revenue when you translate it back to Singapore dollars.
Right, a good reminder that even local-focused companies can get hit by global currency shifts. On the other hand, Sweet Hin Chan Company, SHC, over in Penang, they reported a more significant decline, a 6% decrease in revenue.
And their story really echoes the overall group challenge: reduced demand for their core products, wheat, flour, and starch. Coupled with that same heightened price competition we mentioned earlier, it suggests those specific product categories and, well, that Malaysian market segment are facing some pretty significant headwinds.
And the impact on profitability is, well, pretty stark. The group swung from a pre-tax profit of nearly $500,000 in FY 2023 to a pre-tax loss of $772,000 this year.
That's a really significant reversal from operating at a small profit to a loss before taxes. And when you look at the after-tax result, the loss widened considerably from about $56,000 loss last year to a $1,201,000 loss this year. So yeah, the operational challenges clearly hit the bottom line hard.
And because of that, the board made a decision that directly impacts shareholders. They decided not to recommend a dividend for this financial period,
Which the report frames as, a move to preserve cash and strengthen their financial position. It's a common step for companies facing losses or significant uncertainty. They prioritize the company's stability over immediate shareholder returns.
Okay, so we've seen the financial picture was tough, largely driven by market pressures in key segments. What does the report say about looking forward? Are things improving?
Well, it highlights that these industry trends and competitive pressures aren't just going away. The market remains dynamic and challenging.
But they do point to some potential silver linings, right? I think I saw something about that.
They do. What stands out is the recent recovery of the Malaysian ringgit. They see this as a positive factor.
How so?
Because a stronger ringgit can mean lower import costs for raw materials, potentially improving margins down the line. And they're also seeing some early signs, encouraging ones apparently, of recovery in consumer confidence. That's crucial for their fast-moving consumer goods side.
Okay, so some external factors might be turning slightly in their favor.
Yeah.
However, the report also details ongoing concerns, particularly the big, unpredictable ones, like geopolitical uncertainties.
Absolutely. They specifically mention Ukraine and the Middle East. The relevance here is how these global events can impact their input costs, things like wheat prices,
Right.
and potentially affect export demand for their products. It just makes their operating environment inherently volatile.
And that volatility in commodity prices is explicitly noted as expected to continue impacting performance, making effective risk management a top priority.
Okay, so given that volatility, how does their risk management approach actually look?
Well, the report describes their approach as decentralized.
What does decentralized mean in this context? Like, what does that look like day to day? It means that the primary responsibility for identifying and managing risks isn't all held at the top or in one central department. It's pushed down to the heads of the individual business units. The idea is that the people closest to the operations are best placed to spot potential problems in their specific areas.
Right, that makes sense on paper. But it also means consistency across the group relies heavily on those individual unit heads, which I suppose could be a challenge in a rapidly changing, volatile environment like they're facing.
Exactly. It puts a lot of emphasis on that local accountability. The report also clarifies their overall risk appetite. They operate within a low overall risk range.
And what does operating within a low risk range tell us about their strategy? Are they playing it safe?
It suggests a generally conservative stance, yeah. They state they have almost zero tolerance for safety and compliance risks, which is standard, you'd expect that, but also a low to medium tolerance for strategic and operational risks. This implies they're likely to favor stability and careful steps over, say, high reward, high risk ventures, especially in the current climate.
Okay, got it. Shifting gears slightly, let's dive into the corporate governance section. This gives us insight into how the company is structured and overseen, which is always important, but maybe especially when the company is navigating challenges like these.
Definitely. So the core structure, as of the report date, is a board made up of 7 members. 4 of those are independent directors, meaning they don't have relationships that could interfere with their objective judgment.
Right.
And 3 are executive directors who are involved in the day-to-day running of the business.
So a majority of the board members are independent, which is generally seen as a positive sign for oversight.
Mhm.
And they highlight that because the executive chairman isn't independent, they've appointed a lead independent director. What's the purpose of that role exactly?
The lead independent director essentially acts as a key independent voice and a point of contact, particularly for shareholders. And they can step in if the chairman has a conflict or if the independent directors need to meet separately. It's basically a mechanism to reinforce that crucial independent element on the board,
Makes sense.
especially when the chairman isn't independent, yeah.
The report states that the size and composition of the board are reviewed annually. They want to ensure they have the right mix of expertise, skills, knowledge, experience, and diversity. It's about making sure the team at the top is properly equipped to guide the company.
And their roles are quite distinct. The executive chairman leads the board's strategic direction, while the MD, which interestingly was a vacant position during FY 2024 because a director sadly passed away,
Oh, right.
with decisions handled collectively in the interim, but the MD typically oversees management and day-to-day operations.
Navigating a tough year without a dedicated MD must have added another layer to the challenges they faced.
For sure.
The report also details the key board committees: Audit Committee, AC, Nominating Committee, NC, and Remuneration Committee. Pretty standard stuff.
Yeah, standard but important. These committees have defined responsibilities, like the AC oversees financial reporting and internal controls. The NC manages board appointments and succession planning, and the RC determines executive pay. They report to the main board, but it's made clear that the ultimate responsibility for all decisions still rests with the full board.
Okay. Digging a bit deeper into how governance works in practice. The report covers specifics like how directors actually get appointed.
Right. New directors aren't just rubber stamped, they're appointed by a board resolution, but only after the nominating committee has vetted and approved them. The NC considers recommendations and referrals based on qualifications and how well they fit with the company's strategic needs.
And independence is something they look at annually based on specific code guidelines. The directors themselves confirm their independence. The report specifically notes that none of their independent directors had served for more than 9 years. That's often a point people look at for assessing true independence over time.
Good point. They also track the workload of their directors. The report confirms that none of them held more than the maximum limit of 6 listed board representations. That's a common guideline to ensure directors actually have enough time to devote to their duties at Khong Guan.
An interesting governance practice mentioned is that the independent directors meet at least once a year without management present. Why is that significant?
Well, it's a really valuable mechanism. It allows them to have frank discussions about key matters, financial performance, governance effectiveness, succession planning, executive pay. Basically ensures they can exercise independent oversight without potential influence or perceived influence from management being in the room.
Okay. And how directors are paid is detailed too. The policy includes fixed and variable parts.
Right, aiming to link pay to performance and be competitive with the market. The Remuneration Committee oversees this, and they can get expert advice if needed. The report discloses remuneration details for different categories of directors.
What's interesting here is thinking about how performance is assessed for pay in a year like this one, where the company posted a loss.
Exactly. The report suggests variable pay is linked to performance, so you might infer that those variable components would be significantly impacted by the financial results. Or at least they should be.
The report also covers director training and access. They get formal appointment letters, briefings on the business, kept updated. Importantly, they have independent access to management and the company secretary, and they can seek external professional advice, if needed, at the company's expense.
Yeah, that's all standard good practice. It's about ensuring the board is well-informed and properly supported to do its job.
Okay, now let's look at the system for risk management and internal controls, essentially, how the company protects itself and ensures things run smoothly and compliantly.
Right. As we touched on, their approach to risk management is decentralized. Business unit heads are responsible for their risks. The audit committee plays a key oversight role here.
How does that oversight work?
The AC assesses risk management as part of strengthening processes overall. They oversee the formulation and review of key risk registers. You can think of these as lists of the most significant risks the group faces, along with the plans they have in place to mitigate or respond to them.
Got it. They also have an internal audit function, which is outsourced to an external firm. What's their role?
Their job is to review the effectiveness of internal controls right across the business, financial, operational, compliance, IT, risk management, the whole lot.
And who do they report to?
Crucially, the report highlights that the internal audit team reports directly to the audit committee and has unfettered access to information. That independence is key. Based on their work, the board and AC concluded that the system of internal controls was adequate and effective in FY 2024.
Though they always include that standard caveat, right? That no system can provide absolute assurance against misstatement or loss.
Always. But the assessment was positive.
The report mentions specific policies like an anti-bribery and corruption policy, particularly for their Malaysian subsidiaries, and a whistleblowing policy.
Yeah, these are important compliance measures. The anti-bribery policy is key for preventing illegal activities, especially when you operate across different countries. And the whistleblowing policy provides a confidential channel for staff and even third parties to raise concerns about potential wrongdoing without fearing reprisal. That's really a fundamental part of good governance.
Okay, moving towards the actual financials now. The report includes the auditor's perspective.
Yes, the financial statements were audited by Forvis Mazars LLP, and they provided an unqualified opinion.
Okay, for listeners who might not be deep in accounting jargon, what does unqualified opinion mean in simple terms? Is that good?
Yeah, it's good. It's essentially a clean bill of health from the auditors. It means they believe the financial statements are presented fairly and accurately in all material respects, following the required accounting standards and regulations. In this case, the Companies Act 1967 and Singapore Financial Reporting Standards International. Basically, no major red flags found by the auditors in how the numbers were presented.
Good to know. The report also touches on various accounting policies, explaining how they handle things like recognizing revenue or valuing their assets. Lots of detail there.
Yeah, rather than listing all of them, what's relevant here is that these policies dictate how transactions get translated into the numbers you see in the financial statements. For instance, how they value inventory can impact profitability, especially with volatile commodity prices. How they assess impairment.
Impairment?
Like if the value of assets like the property, plant, and equipment, or even investments in subsidiaries has decreased, that directly impacts their reported asset values and potentially earnings.
Gotcha. And the report points out areas where management has to make judgments and estimates, like useful life of assets for depreciation or assessing trade receivables.
Exactly. Trade receivables is money owed to them by customers. Management has to estimate if some of that might not be fully collected.
And these are important because accounting isn't always black and white, right? Management has to apply judgment.
Precisely. And those estimates can impact the final reported figures. For example, in a year of weakened demand, the judgment around whether customers will actually pay their bills becomes particularly critical. It requires careful estimation of potential losses.
The report also discloses related party transactions. What's that about?
This is all about transparency. It highlights transactions with entities or individuals closely connected to the company or its key personnel. The report specifically mentions transactions with associates of the Chu family, including sales and corporate guarantees.
Right. I saw it notes that Chu Kian Boon Daniel is the nephew of the chairman, Mr. Chu Su Lin.
Yeah, this disclosure is important because it shows where potential conflicts of interest might exist, ensuring everything is above board. A corporate guarantee, for example, is where the company promises to cover a debt if the related party defaults. That's a specific type of financial link that needs disclosing.
Okay, finally, how does the company engage with its shareholders, the people who actually own a piece of the business?
Well, the report emphasizes shareholder rights, particularly the opportunity to participate and vote at general meetings, like the upcoming annual general meeting, the AGM, or any extraordinary general meetings.
And the 2024 AGM is planned as a physical meeting.
Yes, allowing shareholders to attend in person, ask questions directly to the directors and management, and cast their votes. Notices and reports are provided both by post and online ahead of time.
The report specifies that voting for all resolutions at general meetings is done by poll. Why is that important?
It means every share gets a vote, rather than just a show of hands. It's generally seen as enhancing corporate governance because it reflects the proportion of ownership more accurately, more democratic in a way.
Right, and shareholders who can't attend can appoint proxies.
Exactly, up to 2 proxies to attend and vote on their behalf. The report provides specific instructions too, including for investors who hold shares through schemes like CPF or SRS in Singapore, outlining how they need to vote through their agent banks.
So the key takeaway here is they're providing clear ways for all shareholders to exercise their voting rights.
That seems to be the message. Although, interestingly, while the report states there isn't a dedicated formal investor relations policy, the AGM is highlighted as the principal forum for dialogue and interaction with shareholders. That's where they expect to have that direct conversation.
Wow, that's quite a journey through just one company's annual report. We've gone from the specifics of a challenging financial year, the market pressures they faced, all the way to the intricacies of their board structure, how they manage risk in a volatile world, and how they connect with the people who own the business.
It really shows how a deep dive into this kind of source material gives you so many different layers of understanding about a company. It's far beyond just the headline profit or loss figure. You get insight into the operational realities, the strategic thinking given the market, and the fundamental governance structure that's supposed to provide stability and oversight.
Absolutely. It's like getting a 360-degree view, isn't it? Distilling the most important points and what they actually mean in context.
And considering the significant operational loss the company faced in FY 2024, and that strategic decision to hold on to cash by not paying a dividend,
Yes. Where are you going with that?
well, what might that decision imply about the scale of potential risks they are still bracing for? Or perhaps the size of future investment opportunities they might be anticipating. Even as they talk about early signs of recovery in certain areas, retaining cash isn't just about surviving the tough year that passed. It's also about preparing for what's next. It leaves you wondering, what specific challenges or growth initiatives might be on their horizon that require such a focus on preserving financial strengths right now.